The U.S. and China have paused their latest trade escalations after a meeting between Trump and Xi. But according to our featured guest today, investors shouldn't expect a long-term end of hostilities, as this fight is about more than just trade. Joining us now with more is Kevin Hebner, Global Investment Strategist with TD Epic. And Kevin, thanks for joining us again.
Thanks.
Good to have you on the show. Now, you say that at Xi's meeting with Trump, he played the player, not the cards walk. Why don't you walk us through that?
Yeah, so we're using a poker metaphor here, and both of them had very strong cards. That is, a lot of sectors of the economy that they could weaponize against each other. President Xi had rare earths, which has been in the news a lot lately, but China has lots of other cards to play, other choke points. China dominates global production of EVs, batteries. The whole economy runs on batteries, solar panels, drones, industrial robots, and so on. So a lot of choke points, a lot of cards, places, parts of their economy they can weaponize. And similar for the U.S. The U.S. had lots of cards, certainly high-end semis. That's a card they continue to play even now, post-meeting. Access to the U.S. consumer, access to aeronautics, advanced airplane engines, access to the U.S. dollar-based global financial system. So they both have lots of cards, lots of parts of their economy that they have and can weaponize, these choke points. So even cards, but when it came down to it, it was really pain tolerance that dictated the result. President Xi claims that China has a lot of pain tolerance. That's sort of his personal history, his father's history. They suffered a lot. They were punished by the party. President Xi lived for a while in a cave when he was young. He went hungry. And he believes that the suffering brings strength. It builds character. And he's very concerned that young Chinese people are too soft. They haven't suffered. So for him, pain is almost something which he relished, that he almost wanted. President Trump is the opposite. President Trump, as we know, with the TACO trade, doesn't want to take a lot of pain, whether that's job losses, stock markets going down, these things like that. So ultimately, President Xi played Trump in his very low tolerance for pain, instead of the very strong cards President Trump had against the cards that President Xi has.
Okay, so now coming out of those meetings, do you think that going forward, both the U.S. and China have only holstered their trade weapons, not put them away entirely, correct?
Yeah, so the trade weapons we were talking about before, the way that they can weaponize parts of the economy. So they've holstered that, put it aside for a little bit, but ultimately the source of tensions between the two economies aren't going to go away anytime soon. The U.S. was the dominant global economy for decades, and now we have the rise of China, which in many ways is a great thing, but it means we've moved past the old global economic order, hyperglobalization, U.S. dominance, and we're now in this interregnum period, this transitory period, or transition period, which is tricky before we get into the new order. And so there will be a lot of pushing, shoving. The structures of the economy are very different in the two places. Policy is very different, leadership's different. There's also a lot of distrust, mutual suspicion. So these things will come back. 2025 has been very eventful. 2026 is going to be equally eventful. There will likely be 3 meetings of the two leaders next year. President Xi invited Trump to Beijing in April. Then in November, the APEC meeting will be in China. And then next December, the G20 meeting will be at Trump's resort in Florida. So they're going to have 3 opportunities to meet. So with that, I think there's a good opportunity for a broader trade agreement than we heard last week. But there's also a lot of opportunities for disagreements. But I think 26 will be as eventful as 25 for the relationship, the difficult relationship between these two countries.
All right, and how about the bigger picture? I mean, talk to us about the G2 trade war. You see, what does it actually mean about trade?
Yeah, it's not about trade. It's about this new relationship between these two partners. The U.S. has been dominant for so long. China has caught up, and many people view China as the ascending country. and many people think China is relative decline. I'm not in that camp in terms of the United States. I think the U.S. still has a lot of strengths. But we are in developing a new relationship between the two countries. And you could see the last week in South Korea, the two countries really are now equals, and they're equals on the global stage. And that's something that's very different. The United States has been trying, since at least President Clinton, to change the structure of the Chinese economy to hope that as China gets wealthier, it will tend to become more open, more like a liberal democracy. I think last week they realized that's not going to happen, and they're going to have to accept China for what it is. There's still going to be lots of disagreements. There's still going to be lots of pushing and shoving. But ultimately, America is going to have a lot more impact on how this plays out by improving America's own capabilities and how it works with allies, rather than trying to change China going forward.
Okay, so what does this bipolar world mean for Canada and our trade relations going forward?
It means a lot. So Canada did very well in the period of hyperglobalization, and I think you still have a prime minister now who is a globalist, and that's his background is very globalist. Going forward, Canada doesn't have the liberty of being unaligned. So some places like India and Brazil are trying to be unaligned. Canada clearly is aligned with the United States. And given gravity models of trade and so forth, it's always going to be the case that the majority of economic activity that Canada has with other countries will be with the United States.
Just simply geography as well, yeah.
Yeah, mountains, rivers that run north-south, railways, roads, they all run north-south. Canada is so integrated in the U.S. at the economic level, cultural level, and then the personal level. So that's just a reality. So Canada going forward, it does make sense to try to diversify export markets, and Carney's been very active in doing that with the UK, Europe, and places in Asia. But the primary objective really should be improving the relationship with DC and learning how to interact with Trump. Trump faces a lot of challenges. He's got a lot on his plate. He needs a lot of help. And that's one thing we saw last week, is there's a real pivot from Trump to now working more closely with allies. And so there's a lot that Canada can offer Trump as win-wins. So rare earths is happening already. A second area would be Arctic defense. That's important to Trump. Canada is number 2 in terms of icebreakers, for example. Russia's number 1. So this is important to the United States. And then Canada has lots of oil and natural gas, potash, uranium, and so forth. But I think there's more fundamental areas where Canada can cooperate and add value to the United States. One is in terms of AI skills. Canada punches way above its weight in terms of the AI talent pool we have. And I think that's because of the strength of universities in Toronto, Waterloo, Montreal, and so on. But one of our top exports is smart young people to Silicon Valley. And when you go to San Francisco, it seems like every other person you meet is a Canadian. In many cases, they would rather be working in Canada, but there's opportunities greater. So I think that's something Canada needs to be considering more. And it's also the case that Canada punches way below its weight in terms of the export of services. Canada has a lot of great firms in banking, marketing, legal services, and so on. This is just about 80% of employment, actually. It's only 20% of Canada's exports. For the US, it's 30% of exports. The UK, it's 50% of exports. So there's a lot of room for that. And ultimately, so much focus is on natural resources. That's 1.6% of employment. So we can get a little bit of benefit there, but really to move the needle, I think we need to be thinking about digital tech, AI, and other types of services.
Great perspective there. What about the implications for investors going forward, just given that backdrop?
Yeah, so there's a lot. One thing in terms of tech, so critical to the sort of the challenges between the United States and China is tech, and they both want tech supremacy. So I think the tech sector continues to do well, quality tech particular, companies that have high return invested capital, strong free cash flow generation will do well. A second area is you're going to have supply chains built out as America and other Western countries build out their supply chains for sectors like semiconductors, rare earths, and so on, all the choke point sectors that are being home shored. And so there's a lot of opportunities in industrial companies and materials here in the United States. Outside of tech and industrial materials in the US, there's a lot of US companies that trade on a very high valuation premium relative to the counterparts abroad, but fundamentals don't justify that. So we think it makes sense for investors to look at global champions in Europe, in Japan, and even in China. Companies like CATL in batteries, BYD in EVs and AVs. Another opportunity is in infrastructure. So as the United States and other places reshore, reindustrialize, we need lots of work at ports, pipelines, infrastructure for factories. But infrastructure overall as an asset class looks extremely promising. And I think a final implication for investors is the US dollar. The US dollar is about 35% expensive relative to CNY, the renminbi. And the US really cannot reindustrialize and incentive companies to home shore when the US dollar is so expensive relative to China.